Year for his take on rates and the Fed and his outlook for the year ahead. Let's bring in Komal Sri Kumar, president of Sri-Kumar Global Strategies. Thanks for joining us.
Good to be here with you and Leslie.
Thank you.
Good to be.
I think the thing that was most interesting this morning that in the lead up here was what's happening with gold and silver. How do you put all of that in context? You seem to have stocks seem to be able to go up, stocks in general, but also you have this tremendous bid in the precious metals.
You know, I think there is a common element behind all of those, Steve. I've been talking from the beginning of the year, this is going to be a great year for gold and gold stocks. That's how it's been happening. That represents a flight from currencies in general, meaning normally if you were in yen or euro or the British pound sterling, you sought refuge in the US dollar for safe haven. But the US dollar no longer gives you a safe haven. Where do you go? You go to gold. That's what has been happening. On the equity side that you mentioned, it is again a flight from inflation. What is going to give you some protection? Commodities and equities are a way to put your cash rather than leave it just in a bank account and lose value with inflation.
So all of that makes sense, except for here's what doesn't make sense, is that what we look at the five-year forwards or the market's expression or the chips markets of their concern about inflation, there's not a lot there. Why isn't the market expressing the inflation that you suggest?
The market depends on what measure you use. If you look at consumer sentiment, the Conference Board calculations, they show the 5-year forward inflation rate to remain very high, 3.5 to 4%. And that is an average. So that is telling you that there are some people who are expecting it a lot higher than that.
Right. But I mean specifically, I don't think we can get this chart up, but there's a thing called FIN5, F-I-N-5, a daily chart, guys. If you have it in the background there, it's an econ chart. But anyway, it has been relatively quiescent at 2.3, 2.4. Let's move on, Sri. Let's talk about the outlook for the Federal Reserve. The market has priced in essentially a pause in January, pretty much continuing through March, and then April, June, it starts, especially in June when the new Fed chair comes in. The market seems to be suggesting the cutting will continue.
I expect 2026 on the rate side, Steve, to be a very turbulent year, and I'll tell you why. Because if there is a pause in January, as you say, and that's very likely, then the president is not going to be happy with it. He wants substantial reductions. So he's again going to come out and load on Powell and basically say that that is not the right thing to do. Meanwhile, you have all the aspirants to the Fed chairman position who, irrespective of what happens to inflation or growth, they want lower interest rates, because it's almost like they are crying, please make me the next chairman, I will cut interest rates, whatever you want me to do. So you are going to have a Federal Reserve which lacks independence even more than normal. Usually, I've said, there is a problem with the Federal Reserve chairman. As soon as you're nominated, you are trying to get yourself renominated the next time. My suggestion there has been a Fed chairman should have a single 7-year term, and he or she should not be...
That's a good solution, but it's not necessarily the reality we have right now. I think there's two questions raised by what you say. The first is, should the Fed be cutting rates? And the second is, will the Fed cut rates irrespective of the backdrop? And on the second question, what people have come back and kind of debated that notion of the Fed chair will be dovish is that there's a committee, and the committee will restrain the Fed chair. What's your take on that?
I do not think the Fed committee, the Federal Open Market Committee, is going to be able to restrain the chairman. The chair is going to be able to dominate it, and it is going to be dominated by rate cutters. So if you are looking at the majority on the committee, I think you are going to have more rate cuts. And that is the reason why if you're thinking about the number of voters, all you need is a majority to do it. But you're going to have confusion. Now we have a three-way split in terms of how the Fed should behave. You could continue to have that, and that's going to confuse markets during the months to come. And at the same time, the final result is going to be lower interest rates, a steepening of the 2 to 10 Treasury yield curve, because the 10-year, you talked about rates at different maturities, Steve. The 10-year does not respond to what the Fed wants it to do. It's the market determined
That
one.
has